Corporate Governance and ESG, an introduction. Here are the sections of this reading. Section 2 deals with corporate governance overview. The key point here is to understand the different descriptions of corporate governance. Section 3, company stakeholders. Here you need to be able to describe the different stakeholder groups and compare their interests. Section 4, stakeholder management. So you need to understand the description of stakeholder management. Section 5 deals with the board of directors and committees. So you need to understand the functions and responsibilities of the board of directors and the various committees. Section 6, you need to understand the factors which impact stakeholder relationships and corporate governance. Section 7 deals with the various risks associated with poor corporate governance and then the benefits of having a good corporate governance structure. Section 8 gives an overview of analyst considerations in corporate governance. In other words, when you as an analyst are evaluating the corporate governance of a company, what are the items that you need to look at? And finally, Section 9 has to do with ESG considerations. Here, E stands for environmental, S is for social, and G is for governance. Sections 1 through 8 largely cover the governance aspect. Section 9 focuses primarily on environmental issues and social issues. This is a very long and theoretical reading, and it will be almost impossible to remember all the details. But it is essential that you keep your eye on the learning outcomes and make sure that you remember the most important points. These are the points that I have emphasized in this lecture. In some cases, I simply read out segments from the curriculum. And the benefit there is that the curriculum expresses some points in a very good manner. And hopefully by listening to me, you will be able to remember those points. Also, this is the sort of reading that you can easily listen to on your commute to work because there are no calculations. So if you just hear it a few times, that will help you remember the most important points. Section 2, Corporate Governance Overview. The first point here is that corporate governance can be described in many different ways. Here is one definition. Corporate governance is the system of internal controls and procedures by which individual companies are managed. It provides a framework that defines the rights, roles, and responsibilities of management, board, controlling share owners, and minority or non-controlling share owners. Here is another definition. Corporate governance is the system by which companies are directed and controlled. And a third definition is that corporate governance includes a set of relationships between a company's management, its board, its shareholders, and other stakeholders. Now, given the different definitions of corporate governance, it is easy to imagine that corporate governance practices vary from country to country, and in fact, even within a particular jurisdiction, corporate governance practices can vary from company to company. Very broadly speaking, there are two major theories which define specific corporate governance practices. One theory is the shareholder theory, and this is the traditional theory which says that the most important responsibility of a company's managers is to maximize shareholder returns. And in fact, you'll find this definition in many traditional textbooks. If you notice, the first definition is somewhat aligned with shareholder theory because it emphasizes the relationship between management, the board, and shareholders. The board, in a sense, represents the shareholders. The third definition seems to align with shareholder theory because not only is it talking about the relationship between the management, the board, and shareholders, but it also talks about other stakeholders. And this is something we'll discuss in more detail later. This point related to other influences is that specific corporate governance practices are also influenced by the historical, cultural, legal and political aspects of a given region. While corporate governance systems and practices vary from region to region, there is some convergence which is underway. The idea here is that even though specific practices might vary, but corporate governance principles should be the same regardless of where a company is operating. Section 3 has two subsections. 3.1 deals with the different stakeholder groups and their interests. 3.2 deals with the principal agent problem, which has to do with the conflicts between different stakeholder groups. Here is a quick view of the different stakeholders. Perhaps the most important stakeholder is the shareholders. Shareholders provide capital to the company, and they are, in a sense, the owners of the company. Shareholders want the company to do well because as the company value increases, share price goes up, and obviously shareholders are happy. Now, at large public companies, the shareholders elect a board of directors to oversee the company management. So the board of directors is responsible for helping establish the strategy of the company and then ensuring that managers run the company in alignment with the strategy and in the best interest of the owners or shareholders. The board of directors play a central role in the corporate governance framework, and this group will be discussed in a lot more detail later. Next we come to creditors. Creditors are typically banks or bondholders who provide capital to the company, and obviously they expect a certain fixed return from the company. Creditors do not hold voting power, and that's unlike the owners. So owners elect the board of directors, and owners also have voting power over who comes on this board. Creditors do not have that voting power. Creditors are interested in the stability of a company, and as long as the company is profitable enough to make principal payments and interest payments, the creditors are happy. Next we come to suppliers. So suppliers provide goods and services to the company and in return get paid. The interest of suppliers is that they get paid as per their contract and in a timely manner. As with creditors, suppliers are also interested in the company's ability to generate sufficient cash in order to make the promised payments. Customers buy goods and services from the company and pay the company. Obviously, the customers are interested in getting the best possible goods and services at the lowest possible price. Broadly speaking, we can have two categories of customers. We can either have tactical customers or strategic customers. Tactical customers are not impacted too much by the performance of the company, because if the company is not doing too well, customers will simply take their business elsewhere. If a customer is a strategic customer, then they would be more interested in the long-term stability and well-being of the company. Finally, we come to the government or regulators. The government or regulator is interested in ensuring that the company is operating in the best interest of the public and that the company is following the law of the land. The government also gets tax revenue from the company, so in that sense, the government is a major stakeholder. A quick word on stakeholders in non-profit organizations. Here the perspective is different relative to public companies. The board of directors are often called trustees, and the stakeholders would include the board of directors / trustees, the managers and employees who are part of the non-profit organization. Instead of customers, we would typically have donors, and then there will be the people who benefit from the non-profit organization. A key role here is played by the trustees, who need to ensure that the donations coming in are used for the stated purpose of the non-profit organization. Section 3.2, Principal, Agent and Other Relationships in Corporate Governance. The first point here is to understand the principal-agent relationship. This relationship is also called the agency relationship and is fairly straightforward. The principal hires an agent to perform certain duties. Now, since the principal has hired the agent needs to act in the best interest of the principal. The potential conflict is where the agent acts in his own best interest rather than the best interest of the principal. Now, let's apply this to the shareholder and manager-director relationship. The shareholders are the owners of a company. They elect the directors. So we can say the principal in this context is the shareholder who elects the directors. The directors are responsible for hiring the managers, and then the managers in essence run the company. So the directors set the strategy for the company and then oversee the managers. They need to ensure that the managers are running the company in the best interest of the shareholders. So in this context, the shareholders are the principal and the directors/managers are the agents. So what are the possible conflicts of interest? As we said earlier, the major interest of shareholders is that the value of the firm is maximized. The managers, on the other hand, will possibly be more interested in their own personal benefits. So they would want their compensation to be maximized, their perks or perquisites to be maximized, and herein lies a potential conflict, because if the managers are paying themselves too much, that is negatively impacting the value of the firm. Another possible issue has to do with risk tolerance. Now, generally, shareholders will be well diversified, so they would want the company to take an appropriate level of risk so as to maximize the value of the firm. The managers, on the other hand, might be somewhat risk averse, because in addition to maximizing their compensation, managers also want job security. So they are more likely to engage in projects that are relatively safe. So that's one potential mismatch between the risk tolerance level of shareholders and managers. Now, there is another possible situation also. This is where senior managers have stock options, and let's say we have a situation where the options are just out of the money. In this case, managers might be tempted to take excessive risk, because when they take risk, there is a chance that the company will do well and the options will become in the money, and this level of risk might be suitable for the senior managers with stock options, but it might not be the appropriate level of risk for the shareholders. So the larger point is that there is a potential mismatch between the risk tolerance of shareholders/owners and the managers. Another issue has to do with information asymmetry. Clearly, the managers have a lot more information about the company relative to shareholders, and they might make decisions that are not in the best interest of shareholders, and shareholders will not have enough information to evaluate the decisions made by managers. Another conflict arises when the board is influenced by insiders. So we have the shareholders who elect the board of directors, and the board of directors is responsible for overseeing the managers. If this board of directors is dominated by company insiders, then clearly there is an issue, because the board then will be acting in the interest of managers rather than shareholders. Conflicts can also arise between controlling shareholders and minority shareholders. Now, consider a situation where a given shareholder has 51% of the votes and the minority shareholders have 49%. In this case, the controlling shareholders can vote in a way that benefits them and in a way that hurts the minority shareholders. The curriculum gives a couple of examples of how this can happen. So there was a situation where a given company had a controlling shareholder and then there were minority shareholders. When the company was sold, the deal was negotiated such that the controlling shareholders got a higher price for their shares relative to what the minority shareholders got for their shares. Another conflict can happen with related third-party transactions. So let's say that this controlling stakeholder has an ownership stake in another company. Let's call this the third party. If the controlling stakeholder also owns this third party company, potentially this company could buy goods and services here at prices that are above market value. Now, when this happens, obviously the third party benefits, this company loses out, but the controlling stakeholders benefit because they also have ownership over here. Since the company loses out, the minority shareholders lose out. So this is another possible area of conflict between controlling and minority shareholders. Related to this is a situation where we have an equity structure with multiple share classes. So if you have, let's say, share classes A and B, where share class A has voting rights, but share class B does not, then obviously the shareholders with voting rights will execute transactions which are beneficial to them and potentially not beneficial to the other owners of the company who do not have voting rights. Manager and board relationships. So we have a board of directors which is responsible for overseeing the managers of a company. In a situation where we largely have independent directors who are not involved in the day-to-day running of the company, we can have a potential issue whereby the managers do not provide sufficient information to the board, and if the board doesn't have sufficient information, then they cannot adequately oversee the managers. Shareholder versus creditor interests. Now this is fairly straightforward. We have a company. The company gets money from the shareholders and also from creditors. The shareholders are interested in maximizing the value of the company. So the shareholders would like the company to take projects that are somewhat risky so that the overall return is maximized. The creditors, on the other hand, are going to be more risk averse. The creditors would prefer that the company engages in relatively low risk projects so that the risk of default is minimized. There are a few other conflicts that you need to be aware of. One is the conflict between customers and shareholders. Obviously, customers would like that the company sells products and services at as low a price as possible, which would impact the value of the firm. We have a conflict between customers and suppliers. Customers would like easy payment terms, but if a company is getting late payments from customers, then that impacts their ability to pay suppliers in time. There is also a potential conflict between shareholders and governments or regulators, in the sense that shareholders would like to adopt accounting practices that minimize taxes. Another example would be in the banking sector, where the regulator would like to see relatively high equity capital, whereas the owners and shareholders would prefer to have lower equity capital so that return on equity is high.